everybody, welcome to Trading Capital's exclusive analysis. In today's video, we're discussing quite a bit. We're going to be discussing the market as a whole, the S&P 500. We're discussing bond and interest rates. We'll be discussing some individual stocks. And overall, what is transpiring right now in the labor market and the housing market. So there's lots to discuss. This video is a little bit of a technical update, but also more of a macro fundamental video. So starting off with the S&P 500. What has been pushing this market higher and higher? It's been in a clear, strong uptrend. On a weekly chart basis, the SPY got another higher weekly close, closing at 534 on the weekly chart session. Now, the more important thing to note is that you're coming up into this long-term resistance trend line going all the way back to 2007. And right now, we just need to watch that critical area because you can see on Friday, this candle did a peekaboo breakout above and then actually sold in and closed below the previous two higher daily closes. So right now, some sellers definitely are seen off of this resistance zone in the near term. But to speak on a fundamental basis, why has the market been pushing higher with relentless force? And the first thing is that the S&P 500's trailing 12 months operating earnings per share hit another record high in quarter one. It's up over 8% on the last year. So that means there's higher multiples. As well as higher multiples on a fundamental basis, you've had a raging bull market in semiconductors, which has been fueled by an artificial intelligence revolutionary. And this has led to significant multiple expansions in the S&P 500 stocks, and more importantly, in some individual stocks like the likes of NVIDIA and some other leading semiconductor AI plays. Now, the S&P 500's PE has increased from 20.5 to 24.3. It's its highest valuation since we've seen since June of 2021. So if we actually look back at June of 2021 on the charts, let's find when we were at our highest level of PE. So basically since June of 2021, we're looking at an SPY trading at 424, and we're currently well above that. So again, on the weekly chart, if we look at where the S&P 500 was trading in June of 2021, was basically right around in this parabolic fashion. And the markets, even though they were very, very expensive at that time, were actually now testing that area again, the same valuation, but just at a much, much higher price on the technical chart. So you can see in 2021 in June, we actually ended up continuing to push higher and higher and higher. Obviously, the difference is that rates were artificially low. You didn't have this mass tightening in the global economy yet, and you were coming off of that massive COVID low stimulus package that was being unleashed worldwide at unprecedented speed. So definitely a lot of difference in where the markets are now and what we're heading into, but very, very interesting to know that this is the highest valuation the S&P has traded since June of 2021. Now, U.S. equities are certainly outpacing the rest of the world. That is a clear trend that's really been continuing for a number of years now. And within the U.S. markets, we're really seeing a large outperformance in the large caps and mega caps. Specifically, you look at the QQQ, also pushing to new highs here and really keeping a very, very strong technical weekly uptrend, still putting in higher highs and higher lows. So at the moment, large caps and mega caps are certainly carrying this market, and you're seeing a very, very disproportionate rally. When you look at, say, the QQQ, divided, actually we'll do it the other way. When you look at the IWM divided by the QQQ, so small caps divided by mega caps, look at that underperformance. As of Friday, you've had a massive underperformance, yet again, new all-time lows on the underperformance from small caps to mega caps. And that's something as an investor you need to really be paying attention to. Now, the increasing concentration in some of the leading companies, you've obviously seen NVIDIA propelling things higher on a weekly, monthly, daily chart basis. Every single time frame, NVIDIA is just continuing to surge and go parabolic. You're seeing Microsoft continuing its upward ascent. You've seen Apple recently, obviously it was underperforming in a big way, but recently over the last several weeks, 1, 2, 3, 4, 5, 6, 7 weeks, Apple has these weird runs where it underperforms in a big way, and then all of a sudden you get these massive technical weekly rallies that result in upside price. So obviously Apple's starting to play catch up, which has also resulted in the NASDAQ and QQQ pushing up. But just categorizing Microsoft, NVIDIA, Apple, those three stocks alone now make up over 20% of the S&P 500. And an interesting exercise that we can try to do here is if we look at the SPY minus AAPL minus MSFT minus NVDA, let's see what we get here. Look at that. You know, a clear breakdown. When you eliminate those companies, it's a very different looking chart. But overall, the S&P 500, 20% of the index is now made up of just those three companies alone. So again, 20% of the index results from three companies. And there's still another 497 very big companies in the world. Now, this is the highest record going back to 1980. The highest level of concentration in three companies going back to 1980. If we look at a few things, I mean, going back to the mid-2000s, you actually had an extreme concentration in the indices between XOM, Walmart, Procter. Then you go back to before the dot-com crash, the concentration was in Microsoft, GE, and Cisco. Then you look back to the 80s, you had concentration in Exxon again, IBM, and T-Mobile. So I mean, at the moment, you've seen a big shift in the leaders of this market, and certainly Nvidia is a new leader of this market. So the question is Nvidia going to start knocking off the other two? Are other aspects of the AI semiconductor revolution going to try to offset some of these other behemoths that have been on the pedestal for quite a long time? Obviously, Nvidia is the new champion on the block. The question is Microsoft and Apple going to be overtaken? Typically, in long-term cycles, you do see large companies falling off of their pedestal, so that's what I'm watching for in the near term. Now, there's been a clear massive outperformance in the semiconductors. The ratio of the semiconductor ETF to the S&P 500 hitting new all-time highs, surpassing the dot-com 2000 peak. So growth stocks outpacing value stocks in a very significant way. Now, there's a couple interesting things that we're also seeing in the banking sector. Obviously, when you look at, say, the KRE, so regional banks divided by the SPY, take a look what happens. Huge underperformance in the regional banking sector divided by the S&P 500. So obviously in 2023, when we had the first set of bank failures occurring, a lot of people just said, you know what, to hell with it. Let's just buy the major indice, the S&P 500. Let's dump their small regional banks, and that's certainly what this trend is showing, a massive disproportionate underperformance in the regional banking sector. And that could also likely continue in the near term, especially if we see rates elevated for a little bit longer. Now, let's talk about interest rates and bonds. So the U.S. bond market, again, is in a very different state to what the U.S. stock market and equities are showing. The S&P 500 keeps hitting new all-time high after new all-time high after new all-time high. So again, SPY, we look at TLT, take a look at TLT, severe underperformance. If we simply divide the S&P 500 by the TLT, so that's your US 20-year Treasury, S&P is trading near the all-time highs. Do the inverse, TLT divided by SPY, take a look at that. Bonds to the S&P 500 are trading near the all-time lows. So a very significant performing ratio in US stock market equities and bonds. Now, what's it going to take to change this ratio? I mean, if we look back on the weekly chart, TLT divided by SPY, there's been some points in history where bonds just absolutely skyrocketed. Take a look at this ratio. That was your COVID crash. Then obviously you had a little bit of a blip in 2018. That was your Powell taper tantrum. Then we go back to some other crises. Basically, here in 2008, during the GFC, you saw a huge decline in bonds, then a nice little spike, then a big drop again, then a nice little spike. But there's been these massive ratios where bonds all of a sudden catch a massive bid. And the reason they catch a massive bid is because people are using them as a sign of a flight to safety. Usually in times of economic turmoil, slower growth, recessionary, depressionary periods, that's when the bonds typically start to play catch up to the overall market. But clearly a massive underperformance in the bond market. Even if you look at, say, the US 2-year yield, let's pull that up. The US 2-year yield is still trying to hold a bit of a technical uptrend. You know, the Fed fund rate is sitting at about 5.5, 2-year yield's at 4.8, so there's a bit of a discrepancy, so it does give the Federal Reserve some breathing room. But take a look at that candle on Friday. And what's so interesting about this candle formation is we head into next week with the FOMC interest rate decision, and we also head into next week with the CPI. So Wednesday is a blockbuster session. I'm going to highly encourage you to join into our live trading stream on Wednesday at Trading Capital Inc. And basically, we're going to be live trading the Federal Reserve rate decision. We're also going to be live trading the CPI. CPI comes out in the morning at 8:30, and the FOMC rate decision is at 2 p.m. with the Powell press conference at 2:30. And right now, what is so fascinating is we've actually seen the the Bank of Canada cut rates. So a major central bank has now cut rates, basically marking the low here. We've also seen the ECB cut rates as well. And what's so crazy is you've had two major central banks cut rates, and the market was looking for softness in the softness in the interest rate market to continue as people were looking to pile in on the bond trade because we're expecting central bank cuts. And then all of a sudden on Friday, boom, a huge economic data set that comes out and spikes the interest rates in the near term, continuing to show the trend of bonds being in a downtrend. So if central banks around the world are starting to cut, but the bond market is trying to continue to rally, there's a bit of a discrepancy between what the actual market is saying right now and potentially what central banks are moving in forward with their policy rates. So quite a bit of a peculiar time right now in terms of economic policy. One thing is for certain though, when we look at, say, the US 10-year yield, this is a bit of a yield curve inversion. When we look at the US 10-year yield minus, say, the US 2-year yield, oh, let me just redo that. US 10Y minus US 2Y. We're at a very interesting place here. We're still deeply inverted on the 10 and 2 spread. We're also deeply inverted on the 10 and 3 month spread. So right now, the 10 and 2 year spread is pushing in the longest inverted yield curve streak in bond market history. It's over 700 days to be exact. So right now, with the yield curve still inverted, it is pricing in a scenario where, believe it or not, stocks can continue to rally. But we're coming into a time frame here where the yield curve is likely going to make a move where you're going to see either the long end of the curve start to outperform the short end, or the short end start to underperform the long end. So there's going to be a time frame where the yield curve starts to compress back to the 0 point, and that's typically when you get a massive equity market sell-off. I mean, take a look what happened, right? You look at the yield curve inversion back in the 2006, 2007, leading up to your 2008 GFC crisis. Then all of a sudden, bonds started to catch a bid. Boom. And that led to the stock market selling off in a big way, unemployment drastically increasing. So there's a severe correlation. Once the 10 and 2 spread starts to uninvert and get above that 0% mark, look out for the equity markets because something could be a brewing. We don't know what it is. There's been various cycles, your .com, your GFC. What is it going to be this time? Time will certainly tell, but it's shaping up for a potential little bullish wedge to the breakout here. So I'm watching the yield curve spread very closely because as the markets get continuously more and more expensive through saturation in semis, and you're seeing underperformance in other sectors, we have to recognize that at some point the yield curve is going to uninvert, and likely that will be a bit of a potential headwind for the overall stock market. All right, let's continue to move along here. So inflation expectations moving into the CPI report on Wednesday is going to be very important. Right now we've been sticky. We've been in a sticky point on the CPI. If I actually pull up the CPI chart here, that's the wrong one. U.S. consumer price. Whoops, let me just type that in. Price index. Anyways, the chart is escaping me right now. U.S. consumer price. Whoops. CPI. There it is. Sorry about that, guys. So right now the core CPI is sitting at 2.6. Headline is sitting at about 3.4. So what's important about this right now is as the market is still continuing to oscillate between whether we're in a disinflationary trend, whether inflation's starting to reaccelerate. One thing's for certain, we've clearly pulled back from the CPI highs that were back in the 2021-2022 period. Now, the question is, where is inflation going in the near term? Because that is going to likely dictate what the Federal Reserve's policy is. Now, with the Fed fund rate currently sitting 2.5% over the core PCE, that is a very, very restrictive policy. When I actually show you the US federal fund rate, so Fed fund rate, so the effective federal fund rate's sitting at about 5.33, and we actually overlay the core PCE, you can see that the Fed fund rate is sitting at about 5.33%, whereas core PCE is sitting at about 2.6%. So there's a large restrictive policy right now in place. And what's interesting is that has not affected the stock market. It hasn't affected the housing market. It's only affected the bond market at this point in time. So when one of the largest investment sectors of the economy, the bond market, is in a raging long-term bear market, at some point that is going to uninvert, and it's likely going to spill over into other investment asset classes. So right now, a severely restrictive Fed fund rates to where core PC is, and the question is, since we're severely restricted, when is the Fed set to cut? You know, at the start of the year, the Fed was expecting about 6 to 7 rate cuts. And the first one was set to occur in March, after inflation has really been persisting and remaining stubborn on the overall CPI, which is currently still at 3.4%. We've seen a dramatic shift in what the market is pricing in, with only now 1 to 2 cuts, and likely the first one only happening in September. Obviously, things can change on Wednesday if we see a cooler CPI coming in lower than 3.4%, but that's still a big if at the moment. I mean, it does have oil moving lower, which could be helpful in the near term, but the question is, do other commodities start to press higher in the near term to kind of put more upward pressure on the inflation narrative? So right now, the 10-year minus the 3-month is still remaining deeply inverted. It's its longest inversion in history, the 10 and 3 months. We look at real estate. Commercial real estate is still struggling immensely, but residential real estate is still performing quite well. We look at the US Case-Shiller Home Index, and what's really interesting about this is it just hit new all-time highs. So it's still showing us that housing is still at the most unaffordable rate in history, which is quite concerning. Very, very concerning. And it's very saturated in many countries' GDPs. Now, if we continue to move along, in terms of a bit of the house inventory, basically supply has gone down even more, hitting a record low in 2022, as many sellers cannot afford even to buy homes at these interest rates. So recently, the inventory of existing home sales has started to trend higher, but not really enough to bring down the home prices yet. So if we start to see the existing home inventories continue even higher, then that could start to put some more upward pressure on the overall housing market. But we're coming to a point now where the market is starting to want Fed cuts. We're seeing central bank policy starting to cut. Is that going to spur more housing inflation? Because when housing inflation starts to get going again, that is also a problem for the Federal Reserve's 2% mandate. So I'm continuing to watch whether or not the housing Case-Shiller continues to increase, whether or not existing home sales continue to increase. So we have a lot of data to continue to watch on the macro front that's going to influence how interest rate policy is set. Now, commodities are interesting because we've seen massive surges in commodities, whether it was cocoa, gold, silver, uranium, natural gas has been on a tear, oil went on a tear a few weeks back. Commodities across the board have actually started to perform extremely well and actually outperforming their overall long-term trend that we've really been seeing. So a basket I like to follow is the DBC. The DBC chart is showing us some interesting price action. You had your stage 1 basing formation, you broke out, bit of a rejection at double top here, failing, looking to retest back to support. Now the big thing about this DBC ETF is you can see this downsloping trend line, pivot low to pivot low. If we hold this area, DBC ETF could be putting in a very large inverse head and shoulders pattern, which is showing us that, you know what, maybe commodities are not done their overall super cycle run, as some commodity bulls like to call it. So I'm continuing to watch how cocoa performs. 1 year change in cocoa up 212%, coffee 27, silver over 25, zinc, copper, gold up around 20%, aluminum up 16.2, nat gas up 15.2, cotton up 13.3, wheat up 5.5, crude about up 1.5. So a lot of commodities are showing still some upward pressure, which is not going to help that headline CPI lower to the 2% target, where I think we are going to be discussing. All right, so as we continue to move along and we kind of wrap up a few things here, the biggest thing I think we need to watch out for, and what was interesting about Friday's price action, okay, we saw the US 10-year yield absolutely skyrocket on Friday. Take a look at that candle. What looked to be a bit of a bearish breakdown on the daily absolutely reversed back to the high side with a whopping 3.4%. So what's so peculiar about this price action is this is happening right ahead of the Fed meeting, right ahead of the CPI, and right after 2 days of central banks, the ECB and the Bank of Canada, cutting rates. And what's so crazy is I look at the price action in oil, and this is where the Bank of Canada cut right at the low candle, and the very next day is when the ECB cut. So are we starting to see commodities potentially sniff out some weakness in central bank policy? And if that's the case, did gold just confirm potentially central banks, aka the Federal Reserve, having to go back and not follow what the ECB are doing and not follow what the Bank of Canada is? Are commodities going to apply a bit more pressure to the Fed in the near term? I don't think we're going to be seeing the Fed even considering cutting just quite yet. Obviously, that can change according to Wednesday if we see that headline CPI come in lower than the 3.4% consensus that the market is expecting. So again, overall, the U.S. economy continues to grow. It is growing at a slower pace. The 1.3% annualized growth for quarter one this year has moved a lot lower, considering that in quarter four we were growing at about 3.4%. Now the expansion is still continuing. It's about 48 months long during this expansion. Doesn't mean we're going to have to go through a correction, but we still need to watch that GDP consensus. When you look at that GDP now forecast, it has kind of been a very, very volatile forecast, currently sitting at about 3.11% on the forecast. Now, that was an April projection. Let me just see if there's an Atlanta Fed GDP now. Again, that one's sitting at about 1.26 as well. So I'm continuing to watch their projections because, again, they have been slowly lowering their guidance for the GDP projections as of recently. But the question is, do we start to see that GDP pick up? Because if we see GDP pick up and unemployment remaining near these levels, another important thing that we need to discuss is the unemployment rate. So if we look at what happened with unemployment, take a look what we just tagged right now. We're now at that 4% unemployment rate in the US. So what's interesting is we could be entering an environment where GDP starts to slow and potentially contract. We're still a ways away from contraction, but GDP potentially slowing and unemployment starting to uptick. What's really interesting is you're still hearing, the Biden administration, the Democrats touting extremely low unemployment, which is certainly the case. But when you maintain a level of extremely low unemployment, the question is, at some point, there's likely going to be a turning point. It's just the law of averages. Just like we had in 2020, extremely strong downtrend of unemployment, and then boom, a big spike. You're now starting to see unemployment potentially curl and uptick. Again in 2007, a nice hard downtrend in unemployment, and then a big spike up. We go to the 2000, a nice hard downtrend, then a big spike up. So it's just a part of the ebbs and flows of the market. The market goes through these waves of low unemployment and then big spikes. Low unemployment, big spikes. So naturally, when we've seen low unemployment for quite a while now, due to the fact of artificial accommodative policies, now we're seeing restrictive policies potentially trying to narrow that employment gap. Right now, the JOLTS data is still showing that there's about 8 million job vacancies in the States, so that's still at an area where you could have a lot more job openings closed to kind of narrow that overall thesis that the labor market is going to break down. So right now the JOLTS, if I pull up the job openings, so U.S. job openings. So again, JOLTS right now is sitting still at about 8 million job openings. So right now that's still at a high level. Obviously it's significantly down from the high here in 2022, but it's slowly starting to see a pretty big downtrend. So the level that I'm curious and watching very, very closely on the JOLTS numbers, this pre-2018 high where you started declining, and then once you came into this 29 period, this was your COVID dump. But I'm watching this little high pivot here of about 7.6 million on the charts for the job openings. I do think that once we break that level, that might be a little bit of a scenario where you could start to see that yield curve uninvert at a bit of a sharper way. So again, right now, 8 million job openings still shows a fair amount of jobs available in the overall economy. Once that starts to narrow, that could mean a couple things. It could mean people are either starting to look for more work and willing to take jobs just to have a paid income, or it could mean that the economy is slowing down and that there's actually less jobs available to the amount of people looking. So we really got to watch this number, but I'm watching this 7.6 number high pivot on the JOLTS data very, very closely as we progress through the next couple months. Because unemployment is starting to increase, as this starts to fall, you're going to see unemployment likely also continue a bit of an uptrend, which that's typically when you start to see bonds catching a bid and equities starting to sell. All right, other than that, I think I'm going to sum up the market here with a couple thoughts. Obviously, we've gone over a lot of macro data in this video. It's a little bit overwhelming if you're new to the world of investing and trading. This video is not really for trading, it's just to give you a macro picture. But it's important to understand a bit of the macroeconomics because it does influence on a daily, weekly, monthly chart basis where equities are going to be going. And as a trader, we need to know, is the economy breaking down? Are bonds likely going to catch a bid? Because if that is, it means a lot of different assets are going to actually see price action decline and others rally. So you need to understand the macro because it does help us with the overall trend in the market, whether or not we need to be aggressive with equities, piling on risk, piling on margin, or do we need to move our capital more defensively? So in summary, the market right now is still at an okay point. It hasn't broken down. The labor market hasn't broken down. The JOLTS number is still okay. We're still at an area where the market is still chugging along. And that can continue to trend, but at some point we will see a bit of a shift and turn. That's just what the trend in JOLTS is saying, the potential short-term trend in unemployment is saying. And you need to be mindful about this massive trend switch because it will happen, but the question is when. So if you're interested to see how I'm trading things here, definitely check out my Trading Capital website and in the link below, and we'll see you on the charts a little bit later.